when you're looking at the fees, how I've kind of processed this for myself, right? And I myself do have a first lien HELOC, right, that I acquired last year. And when I looked at the amount I paid in fees versus all the other benefits I get with having this product, it's as if the fees totally offset itself, not upfront, but over time, I recapture that. If I would have bought and went the conventional route, right? Because my particular strategy was I put 10% down. I had a total of 20%. And I'm pretty sure there's, a strategy mentioned earlier with the all-in-one, whether you do 10% down, have the mortgage insurance, pay that little fee, and then dump your other 10 in there. You've now freed up the line. So, I definitely want to address that real quick. So there's, a couple different options here as it relates to how you put money down on a home. When you put 10%, 20% down on a conventional mortgage, you lose access to all of that 10, 20%, right? That you cannot re-access that unless you took out a second loan on the property. Correct. Versus in an all-in-one, right, you could put 10% down, but let's say you had 20, right? So you put 10 down, you pay the little mortgage insurance fee and all the other fees that we're going to dive into. And then once the line of credit is active, dump your other 10% in there, even though you might be at a higher rate, you now have liquid access to that other 10.
Yeah. I mean, the rate wouldn't change realistically.
Right. And the line of credit is bigger. The line of credit is bigger now.
Exactly.
Right? As opposed to, because when you do 500,000 times 20%, your line of credit is based off of that 80% mark versus a 90% line of credit, and then put 10% down. You now have an additional reserve that you automatically built in to the line of credit. Yeah. Real cool stuff. All right, so let's do fees. Let's break this down in detail. And I know there's nuances, but you can give us like the general like fee.
So you have the first and foremost is going to be the discount points. If you're buying your rate down, it's more expensive. If you're picking the highest margin option, it's cheaper. So just cost for the margin.
Discount fees or margin. Okay, that's buying the rate down. Yes. And again, this is a way of thinking that is going to require education, because oftentimes we're always so focused on the rate, which it does matter. It has some importance to it. But when you start getting into, well, what is the value of me keeping more of my capital even though I'm at a higher interest rate? So 8.78%, right? The margin saying going with the highest. So 4% would be the highest, which is also the cheapest cost. And then say 4.78. So now you're at a total of 8.78 as opposed to 4 minus 2.5. So minus a point and a half off of that. So 7.28. So you have an option. Either I give myself a 7.28 rate now on my all-in-one, but I have to pay these additional fees to get there, or go with the 8.78, lesser fees, lesser costs up front. That money that you were already going to pay, stick it in the all-in-one.
Exactly. You're saving more money and you're paying your home off faster. Exactly.
Yeah.
I mean, and that's the part which makes sense for me. It's the philosophy of the individual. What are you trying to accomplish? Do you want to leverage yourself, or do you want to eliminate debt? Sometimes that flip-flops between days, weeks, months, decades, right? If the person comes to me and says, hey, I got a bunch of equity in my home, I'm 35 years old and I'm trying to buy rentals, he's trying to leverage himself. That person is now not 35, but 58 years old. Okay, maybe they owe some money on their home. They're trying to pay it off before their wife or they retire. Great. Now we're focusing on something else. In argument's sake, you could say it probably makes sense to, depending on your scenario, to buy the margin down, but we we just run a math problem. We look
Yeah.
at what your cost is. We look at how much it ends up saving you based off your scenario. Does it make sense to save 30 grand extra if it only cost you 9 grand? Yes, I would say yes. That's a big enough gap.
Yeah, and it's in, you said 2.5 increments.
Increment.
And
Yes.
so is there a rough estimate on how much every 0.25 would cost that individual? You have to do that 6 times to get to 2.5,
Yeah,
right?
so it's not perfect every way, but um, 4%, depending on obviously the credit. There's this is just base pricing per people's credit scores, and multi-million dollar homes change
All right.
this a little bit, but just
Let's
base
let's
price.
let's do let's do a 700 credit score on a 500K home, and I'm deciding with Harrison between an 8.78, or if I want to buy it down 1.5% by 2.5, right? So it's
Yeah.
six times. Yeah. So roughly, what would that?
So I mean, and I think that's kind of the hard part is I think that the best way to go about it really is to say, depending on the lowest margin, you could be spending between a 0.25 in cost all the way up. Sorry, my apologies. The highest margin, the 4% margin could be a 0.25% in cost, so a quarter of a cost. The 2.5 margin could
Mhm.
be 2.75 in cost. It's between a
75.
0.5 and yeah.
Okay. So it's between
So
zero point 0.5, 2.75 on that margin of 2.5%. So you're going to pay 2.75% on what? The loan amount?
whatever your initial draw is on the loan. So if you owe 500,000 on $1 million home, it's going to be based off 500,000. If
Got it.
you
Clear.
not off the $800,000 line of credit.
Got it.
Now, when you start getting into credit scores, again, there's the tiered adjustment. So in the higher 800s, you're going to have little to no pricing adjustments and potentially
Yes.
even rebates. And
Hmm.
the closer you get to 700, you're going to have increased costs.
Yes.
So at a 700 credit score on an 80% loan to value, you could see an increased cost for that individual because they're kind of right there on the threshold of being the right candidate versus not being the right candidate. And as you get
Got it.
further away from that line, you're going to be put into a much better position.
So I'm calculating like 13 grand, almost 14 grand. Is that right?
On
On
on what?
on the 500K, I times it by 2.75%.
13,750. That's just for the margin if you bought your rate down. Yes.
Guys, like I don't know how, like that 13,750 for me is more valuable in a higher rate line of credit, and we're only talking a 1.5 difference right now.
Yeah.
If it was a 4 point difference, maybe it gets a little interesting there to run some math. But for me to save that 13,750 in fee, and me just say I'm gonna have that 13,750 in reserve in the line of credit, and that's gonna help me accelerate the line down faster. For me, that's more valuable. So
Well,
okay,
here's
so there.
even
Go ahead.
sorry, my apologies. There's actually a really unique math problem you can run is let's compare it one to the other. So the difference in cost from a 4% margin versus a 2.5% margin is
Yeah,
2.5 in cost. So that individual is going to spend 12,500 to get the lowest margin. They're going to spend that much more as opposed to getting the highest margin. But you're saving 1.5 every single year. So it's going to cost you 12,500 to get the lowest margin, but on a $500,000 balance, it's going to save you $7,500 in interest each year. So you're going to break even in about 1.6 years.
uh,
So mathematically, you will be in the black as soon as you finish the second year, as long as nothing else changes, or if you continue to pay your balance down, then obviously it mathematically makes more sense for you.
okay, got it. So we got fees for the margin
Yep.
between 2.75%, right? I can write that. And what is the cost for the four again?
0.25.
0.25. Got it. So did I write it correctly like that? 2.5% is the difference.
The cost for 2.75 is 2 point. Sorry. Oh, yes. Okay. Yes. I see what you're saying.
I said
That's
it
the
right.
cost. Correct. Yep. You're right.
Got it. Okay. So that means on a $500,000 line of credit at 4% margin, CMT 4.78, I'm at an 8.78 rate. I paid 0.25% on 500K.
Exactly.
I see. And so that is $1,250. That is a massive savings up front, right? And if we incorporate the strategy of velocity banking now, because here's the other thing, there's a lot of people, I shouldn't say a lot, but there's a good percentage amount of people who acquire the all-in-one loan product and still not necessarily know how to do the strategy of where I come in, right? And how I teach how you can strategically use this thing. And yes, there's some automation to it, but there's still the nuances that people aren't fully aware of how they could be paying this down even faster. And so when you combine that with the product, because now we're just comparing product to product, 2.75 cost versus 2.5 cost versus the payment over a period of time, 1.6 years, there's a break even, da da da. Okay, well, what if we now incorporate the strategy, what I'm teaching, dumping all your income in, we're funneling savings through here, we're using credit cards and cashback rewards and points and miles and da-da-da and the whole 0% cards and balance transferring and all these different things, 0.25 starts to look really attractive because again, it's less capital up front and I get to recapture all that here right now. So yeah, a lot of cool things that are just going in my head here. So 0.25 to 2.7, that's the margin. What are some other fees?
Yep. You have the CMG fees, our fees.
Right, that is
About
the underwriting fee, right?
$1,500.
That's the underwriting fee, right?
Processing, underwriting, correct.
Okay.
Setup, admin, all those things. Yeah, about $1,500. Then you have appraisal. The cheapest appraisal I've seen in recent months has been about $500 to, in certain areas where we needed to maybe order 2 appraisals, maybe up to $1,200, where values are, multi-million-dollar properties. Really just depends on where the property is. That's kind of a very broad range. I'd easily say $750 is kind of is right there, dead in the middle.
Got it.
Title fees, again, all it's going to be based off of what that loan amount ends up being. Could be $2,200 to $3,500. That's the part where it really is just going to depend on where that property is located.
Yes,
What that
2,200
loan amount
to what did you say? About as
call
high
it
as
3,500. 3,500, yeah.
and then you've got title fees is also with the state, right? Like there's also these other state fees.
That's all. Yep, that's going to be all dialed in with the title company.
Okay, got it.
And then lastly, if you're buying a home, you're going to need 1 year's worth of homeowners insurance. If you're refinancing,
Right.
which we've seen a lot of people right now get out of their low, their 3, 2.5, 3.25 interest rate loans because they bought it when the value was here. Over the last few years, it's gone up to here. They don't owe all too much, and they are able to just save, and really leverage themselves. So most of the transactions we've seen recently actually have been people refinancing into this product, which is awesome because at the end of the day, they needed to buy the home. Maybe they bought it with 3% down and the values have gone up drastically and now they're at an 80% loan to value. They've been able to take advantage of their equity growth while also saving money over here. It's kind of been a powerhouse for them to kind of go down the path of savings and building equity without changing anything and contributing a boatload of their own money.
We're gonna have to spend more time on that. That's interesting.